121 million people just discovered they cannot access their own money. Not because their banks failed, not because their accounts were frozen for legal reasons, not because of technical malfunctions, because the global banking system has systematically eliminated cash withdrawal rights while maintaining the illusion that deposits represent accessible money. This is the $19 trillion heist, and it's happening in plain sight. Let me show you exactly how this coordinated cash lockdown operates. Let me walk you through the mechanisms that have transformed bank deposits from money you own into digital credits you cannot access. And let me explain why this represents the final stage of monetary control that eliminates financial privacy and personal economic autonomy. Because when you understand the withdrawal restrictions, when you see the digital infrastructure, when you recognize the coordinated policy implementation, you realize this is not banking evolution. This is systematic theft disguised as modernization. The cash withdrawal crisis is not accidental. It is architectural. Every totalitarian system in history required monetary control to achieve complete population management. Physical cash represents the last form of anonymous economic transaction that governments and banks cannot monitor, control, or prevent. The systematic elimination of cash access represents the final step toward complete financial surveillance and control. The numbers are staggering and accelerating. 121 million people across developed economies now face practical barriers to accessing their own deposits through systematic withdrawal limitations, ATM restrictions, and digital-only banking policies that eliminate cash as a viable transaction medium. But the affected population represents only the visible portion of a systematic transformation that affects every person who maintains bank deposits. $19 trillion in bank deposits worldwide now exist primarily as digital entries that banks control rather than physical currency that depositors can access independently. Traditional banking theory holds that deposits represent a liability for banks and an asset for depositors. Customers deposit money, banks hold it safely, and customers can withdraw their money on demand. This fundamental relationship has been systematically reversed without public acknowledgement or legal framework changes that would notify depositors of their reduced property rights. Modern banking operates on fractional reserve principles, where banks hold approximately 10% of deposits as physical currency while lending out the remaining 90%. This system functions normally when withdrawal demands remain predictable and distributed over time, but systematic cash elimination has reduced even the 10% reserve requirement to near zero in many institutions. The practical effect transforms bank deposits from money you own into credit you hope to access when banks permit withdrawal. This represents a fundamental change in property rights that occurred without constitutional amendments, legislative authorization, or public consent. Banks simply implemented withdrawal restrictions and called it modernization. Digital banking infrastructure enables this transformation through technological capabilities that did not exist when current banking laws were written. Mobile banking apps, online transfer systems, and digital payment networks allow banks to direct customer behavior away from cash transactions toward monitored digital payments that banks and governments can track, tax, and control. The withdrawal restriction mechanisms operate through multiple coordinated channels that make cash access increasingly difficult without explicitly prohibiting cash transactions. ATM withdrawal limits have been reduced systematically across major banking networks. Daily limits that once allowed substantial cash access now restrict withdrawals to amounts insufficient for significant purchases or emergency needs. Branch banking services have been eliminated systematically through consolidation and closure programs that remove physical locations where customers could access larger cash amounts. Bank branches that remain open often implement appointment requirements, advance notice periods, and suspicious activity reporting for cash withdrawals exceeding arbitrary thresholds. Currency availability has been restricted artificially through Federal Reserve distribution policies and commercial bank ordering limitations that create artificial scarcity of physical currency. Banks report they cannot provide requested cash amounts because they lack sufficient physical currency inventory to meet customer demand. But currency scarcity is manufactured rather than natural. Central banks control currency printing and distribution and can increase physical currency availability instantly if policy priorities favor cash accessibility over digital control. Current scarcity reflects policy choices rather than technical limitations or economic constraints. The legal framework supporting cash elimination operates through regulatory interpretation rather than legislative authorization. Bank regulators implement anti-money laundering, suspicious activity reporting, and know your customer requirements that treat cash transactions as inherently suspicious and subject to investigation, reporting, and potential account closure. These regulatory requirements effectively criminalize normal cash usage by requiring banks to report cash transactions, investigate customer behavior, and terminate relationships with customers who prefer cash transactions over digital payments. Banks avoid regulatory scrutiny by discouraging cash transactions through operational barriers and customer steering toward digital alternatives. International coordination suggests systematic planning rather than coincidental policy development. European Union, United States, Canada, Australia, and other developed economies implement nearly identical cash restriction policies simultaneously despite different legal systems, political structures, and economic conditions. This coordination indicates central planning and implementation rather than independent policy development by sovereign governments responding to domestic conditions. The uniformity of implementation suggests international agreements or organizational coordination that bypasses normal democratic legislative processes. The surveillance infrastructure enabled by cash elimination represents the primary motivation for systematic withdrawal restrictions. Every digital transaction creates permanent records that governments and banks can access, analyze, and use for tax enforcement, behavior monitoring, and population control purposes that physical cash transactions cannot provide. Digital payment systems record transaction amounts, locations, times, merchant identities, and customer behavior patterns that enable comprehensive population surveillance through financial activity monitoring. This surveillance capability exceeds what historical authoritarian governments achieved through secret police, informant networks, or physical surveillance systems. Modern digital surveillance operates continuously, automatically, and comprehensively through financial transaction monitoring that captures every economic decision, personal preference, and behavioral pattern that involves monetary exchange. This represents total economic surveillance that makes political control infinitely easier than historical authoritarian systems achieved. Central bank digital currencies represent the ultimate implementation of cash elimination and financial control. CBDCs eliminate physical currency entirely while providing governments direct control over individual spending, saving, and transaction capabilities through programmable money that can be restricted, directed, or eliminated based on government preferences. Current CBDC development programs in major economies indicate systematic planning for complete cash elimination and replacement with government-controlled digital currency that eliminates financial privacy and personal economic autonomy entirely. These systems will make current withdrawal restrictions appear minor compared to comprehensive financial control that CBDCs enable. The economic implications of cash elimination extend beyond individual privacy concerns into systematic changes in economic behavior, market dynamics, and price discovery mechanisms that depend on anonymous transactions and unmonitored exchange for optimal function. Cash transactions enable informal economy activity, small business operations, and personal economic relationships that cannot function efficiently under comprehensive surveillance and transaction monitoring. The informal economy represents significant economic activity that formal digital systems cannot accommodate without substantial efficiency losses. Small businesses depend on cash transactions for operational flexibility, customer privacy, and regulatory compliance simplification. The digital payment systems complicate through reporting requirements, transaction fees, technological complexity that many small operators cannot manage effectively. Personal economic relationships involving gifts, family support, charitable giving, and community mutual aid function optimally through cash transactions that preserve privacy and avoid transaction costs, reporting requirements, and technological barriers that digital systems impose on simple economic exchanges. The elimination of these economic relationships through cash restrictions reduces overall economic efficiency and social cohesion by forcing all economic activity into monitored digital channels that cannot accommodate the full range of human economic behavior and social cooperation. Emergency preparedness represents another critical concern as cash elimination creates systemic vulnerability to infrastructure failure, cyber attacks, or intentional system disruption that could eliminate access to all financial resources simultaneously. Physical cash provides backup financial capability that digital systems cannot replicate during infrastructure failures. Natural disasters, power grid failures, internet disruptions, and cyber attacks can eliminate digital payment capability entirely, while physical cash remains functional for essential transactions during emergency periods. Cash elimination removes this backup capability and creates systematic vulnerability to infrastructure disruption. Historical precedents demonstrate that governments frequently restrict financial access during political crises, economic emergencies, or social unrest. Digital financial systems enable instant and comprehensive financial restriction capabilities that governments can implement immediately without advance warning or legal procedures that physical cash systems would require. Bank holidays, account freezes, and transaction restrictions become technically trivial to implement through digital banking systems that can be controlled centrally, rather than requiring physical bank branch cooperation and vault security that physical cash systems require for financial restriction implementation. The resistance mechanisms available to citizens become increasingly limited as cash elimination progresses and alternative financial systems face regulatory restriction and technological barriers that prevent effective implementation. Cryptocurrency, precious metals, and barter systems provide partial alternatives but face systematic government restriction and practical limitations for daily economic activity. Cryptocurrency systems face regulatory restriction, taxation requirements, and technological barriers that prevent mainstream adoption, while government digital currencies are designed to provide government control over individual financial activity rather than financial freedom and privacy that early cryptocurrency advocates promoted. Precious metals provide value storage but lack practical transaction capability for daily economic activity while facing government restrictions on ownership, transportation, and commercial use that limit effectiveness as cash alternatives during systematic financial control implementation. Barter systems provide local transaction capability but cannot scale to modern economic complexity while facing legal restrictions and practical limitations that prevent effective replacement of monetary systems for comprehensive economic activity requirements. The international implications include systematic financial control coordination between governments that eliminates geographical arbitrage, opportunities for individuals seeking financial privacy and autonomy through international banking, cryptocurrency exchanges, or alternative financial systems that operate across national boundaries. International banking cooperation enables comprehensive financial surveillance and control coordination between governments that eliminates traditional offshore banking privacy and alternative financial system access that historically provided individual financial sovereignty options during domestic financial control implementation. The technological infrastructure supporting systematic cash elimination represents massive investment in surveillance and control systems that indicate long-term planning and comprehensive implementation rather than temporary emergency measures or gradual policy evolution responding to changing economic conditions. Artificial intelligence systems, behavioral analysis algorithms, and automated reporting systems represent sophisticated technological infrastructure designed for comprehensive population financial monitoring that exceeds any legitimate banking or regulatory requirement while providing unprecedented government control over individual economic behavior. The legal challenges to systematic cash elimination face jurisdictional complexity, regulatory capture, and technological implementation that bypasses traditional legal protections through administrative policy rather than legislative authorization that would require public debate and constitutional review. Constitutional protections for property rights, privacy rights, and due process rights face systematic circumvention through regulatory interpretation and technological implementation that achieves comprehensive financial control without explicit legal authorization that would trigger constitutional review and democratic oversight. The time horizon for complete cash elimination indicates systematic implementation over multiple years, rather than immediate transition that would trigger public resistance and political opposition. Gradual implementation reduces public awareness while achieving identical control objectives through incremental restriction rather than obvious elimination. Current withdrawal restrictions represent intermediate implementation rather than final objectives. As systematic cash elimination progresses toward complete digital financial systems that eliminate physical currency entirely while providing comprehensive government control over individual economic activity. The resistance timeline indicates decreasing opportunities for effective opposition as infrastructure development and regulatory implementation create irreversible systemic changes that become increasingly difficult to reverse through democratic processes or individual action. Public awareness remains limited while implementation accelerates through regulatory policy rather than legislative process that would create public debate and political oversight of systematic financial control development and implementation across multiple national jurisdictions simultaneously. The ultimate objectives include comprehensive population control through financial surveillance and transaction restriction that enables political control exceeding what historical authoritarian governments achieved through physical coercion and surveillance systems that required massive human resources and technological infrastructure. Modern digital financial control provides automated, comprehensive, and instantaneous population monitoring and control capabilities that make traditional authoritarian systems appear primitive, while achieving superior population management through voluntary adoption of technological systems that individuals believe provide convenience rather than control. This represents the most sophisticated population control system in human history, disguised as technological advancement and banking modernization that individuals adopt voluntarily while surrendering fundamental economic rights and financial sovereignty without recognizing the systematic nature of the transformation. The $19 trillion heist is not about money theft in traditional terms. It is about freedom theft through systematic elimination of financial autonomy and economic privacy that enables political control impossible under monetary systems that preserve individual economic sovereignty through cash accessibility. 121 million people represent the advanced portion of systematic financial control implementation that will eventually encompass every individual who participates in digital banking systems that prioritize government surveillance and control over individual financial rights and economic autonomy. The heist is complete when physical cash disappears entirely and all economic activity occurs through digital systems that governments and banks control completely. This transformation is nearly complete across developed economies where withdrawal restrictions represent final implementation rather than initial experimentation. Mathematical inevitability suggests complete cash elimination within the next 5 to 10 years as current withdrawal restrictions expand and alternative financial systems face regulatory elimination, while public awareness remains insufficient to generate effective political resistance to systematic financial control implementation. The timeline for resistance becomes increasingly limited as infrastructure development creates irreversible systemic changes, while regulatory capture eliminates democratic oversight of policies that achieve comprehensive population control through technological implementation rather than legal authorization. Cash withdrawal restrictions represent systematic theft of financial sovereignty disguised as banking modernization. The $19 trillion represents the total amount of individual financial autonomy being transferred from depositors to banking and government control systems. This is not temporary policy responding to emergency conditions. This is permanent infrastructure for population control that will persist and expand regardless of political changes or economic conditions, because technological capabilities enable control that governments cannot voluntarily surrender once implemented. The Great Cash Withdrawal Lockdown represents the final phase of monetary freedom elimination. And the mathematics guarantee its success unless public resistance develops rapidly enough to reverse systematic implementation, before infrastructure development makes reversal technically impossible.